Hello, and welcome to the Wade Borth podcast. I'm your host, Wade Borth, and in every episode, my goal is to get you to think differently about how money works and ultimately to empower you to take control of your money and your personal financing system. Welcome back to the Wade Borth podcast. Exciting conversation we're having with David Zapata, a good friend of mine at Factum Financial, partner. It's always a pleasure to have the conversation with David. This conversation is about our tough money conversation, our tough money curriculum. Again, it's this idea of how do we exercise our money? How do we put our money in a good position? This is one of the things I always said when I was playing college football. I said, coaches can put you in a good position. Mm-hmm. If you have a really good coach, and I had a really good defensive coordinator, he always put me in a good position. But it was up to me to make the tackle. And so where I see this conversation is that awareness, the education, and really some action items that puts us in a good position. And then when we are in a good position, how are we able to make that tackle? So I'm excited. Again, if you haven't listened to part one or part two on the tough money curriculum, the tough money conversation, I would encourage you to go back and listen to those because that's setting the groundwork for where this is going. And really this comes from a place of having a great relationship with our money, a really close relationship with our money. And if we're able to have that close relationship, we know what's going on. And I heard Nelson Nash say this one time. He says, if people know what's going on, they're going to know what to do. And again, we don't say anything's right or wrong. It's about bringing awareness. And then once you have awareness about what's going on with your finances, you can make sure that your finances are aligned with your values. Because again, that's where we find that true harmony. And we find people that are finding freedom in their life is because they're having their money in alignment with their values. And what's so funny, and we're not going to really get on this avenue, is that we see a lot of times where people will say one thing that's important to them, but they do exactly the opposite with their money. Like, I need liquidity, I need money, I need access to money all the time, but then they're going to go tie it up in a 401k for the next 30 years. I'm like, how is that alignment? And again, I'm not saying 401k is wrong. That's not what I'm saying. All I'm saying is like that set of values is not in alignment with their actions. So this is really designed to say, let's bring some awareness to that. Let's bring some education. Give you a couple of opportunities to implement some changes in your life so you can align your money with what your values are. So Again, the first one was the conversation we had was just about the saving strategies. And the second part was about debt and just that conversation around debt and how do we have that. And again, this is a snorkeling exercise. We're going to go very high level and we're not going to go real deep. If you want to go real deep, contact David, contact myself, David Zapata at Factum Financial. All this will be in the show notes down below. But David, did I do a good recap of where we've been so far and maybe give us a little preview to where we're going to go?
Fantastic. I think now the conversation goes towards how do we translate the income, the uncommon income you may have into wealth, into your balance sheet, into the assets you own and control. And like you were saying, Wade, this conversation definitely needs to start with reviewing your income statement because nothing will move forward unless you're able to retain some of the income you earn in the form of savings. You need to manage your spending, you need to manage your debt. And we just had those two conversations. Once we move forward and we now go down in your financial statement to your balance sheet, assets and liabilities, we need to get very clear that the reason we hold those savings is so we can store them as reserves in a portion of our balance sheet to create what we call liquidity, the ability to access cash as soon as possible. And it will have two functions. This is one of the things we constantly talk about liquidity. In one side of the spectrum is money in our reserves that protect us against events with tough money. Think about 2008 and the ability to have liquidity to float yourself through a recession. And on the other side of the spectrum is the ability to take advantage of opportunity, the ability to have reserves to go and buy things that are for sale when most people don't have the funds to go buy them. Think about 2011 and how you could have bought houses at $60,000 cash and built a lot of wealth if you have liquidity. Liquidity plays a really key function, but unfortunately is one of those conversations that people don't find sexy and that we are misunderstanding and misclassifying in our current economic education in our society. So the most important idea, and this is very controversial, we separate this conversation in two exercises in the workbook. Our savings environment, where are we going to go store those savings to create liquidity, and an actual liquidity strategy. How much of it do we need? How much liquid assets do we actually need? But the fascinating part of this part of the conversation, Wade, is that people have a mumbo jumbo in their balance sheet where everything is the same. It's all balance sheet items. It's all stuff that I own. And the first portion of classification that I think would be really helpful for people is to separate their balance sheet. At the top, think about things that are security assets, liquid, safe assets. And at the bottom, everything else represents an investment, things that you own because they pay you to own them that have some inherent risk to it.
Yeah.
So,
Yeah. So just a point of clarification: when you say security assets, that's again, Nelson talks about misclassification, right? What we're talking about is safe, secure dollars, not securities, right? So I know people are
correct.
listening like, "Oh, it's my securities." No, it's absolutely the exact opposite. There's nothing secure about securities. What we're
Mhm.
talking about is those things that are safe, secure, and guaranteed, right? That's what we call security assets, and that's. And again, I'm going to make one comment. Is like, what's the difference between opportunity and chaos in people's lives? It's typically if they have money.
That's funny.
Liquidity is that bridge, the difference between opportunity and chaos in their lives. And we've all seen this. We saw this back in, during the pandemic, how many restaurants were closing and how many stayed open, how many thrived afterwards, or you go back to '08 and '09, 10, so on and so forth. It's just always the difference is like who has money when nobody else does. That's usually the difference between chaos in people's lives versus opportunity. So,
Let's drive that point deeply. So let's get a couple of visuals to understand what we're talking about more. So you are exactly right. When I talk about security, I'm talking about the foundational part of your balance sheet that is liquid and safe assets. And we need to get very clear about what those things are. But before we go there, think about building a house. And we joke about this in our presentations all the time. No one coming into your house says, "My God, the foundation of your house is gorgeous. Holy cow," right? They will look at the windows, walls, right? The house itself. But there's no question that in order to have that house built, you must put a proper foundation because you want that to be there for 30, 50, 100 years. The same is true if you're going to build a skyscraper in New York City. You're not going to have a conversation about the foundation, but the taller that building gets, the stronger the foundation must be. And most Americans build their financial house with the roof down. They will have a conversation very excited about the shiny objects in their investment portfolio without not recognizing there's $2,000 on a savings account supporting the whole thing.
yeah,
Not a proper foundation. So we need to go back and focus on the fact that as we build wealth, supporting the wealth and the investments with the strong foundation is critical for the longevity and success of that endeavor. In other words, for every reason you have to invest, you have a greater reason to have strong foundation through liquid and safe assets. This is why banks constantly are measured against their reserves. For all the risks they take, they have a reserve ratio required to protect them. This is true for corporations. This is true for endowments. This is true for all the wealthy people around the world. So let's go on the first portion. Now that we're talking about the foundation of your balance sheet, Wade, we talk about liquid safe assets. So we are going to have a conversation about savings environments. Where are we receiving those savings? And where are we placing them in assets we own that are liquid and safe? So the exercise starts by identifying where do we have liquidity? And we list a series of assets in that exercise, Wade. We talk about savings accounts. We talk about maybe cash you have in a safe at home. Maybe you have some precious metals at home. Maybe you own life insurance and your cash values are a way to store liquid safe assets in that life insurance policy. Maybe you're a little more sophisticated and you use treasuries. You ladder 30, 60, 90 days treasuries to get some yield from the government and then have liquid safe assets. Maybe you own CDs. Maybe you even have a money market account that's just allocated in cash. All those represent liquid safe assets that do not have any risk of loss and that are rather accessible if you need the liquidity. And the most common conversation here is this. Oh, David, should we put our 401k in here? Oh, should we put our retirement accounts in here? David, should I add the equity of my home in here? And the most important takeaway from this podcast, if you hear me say anything, is get clear about what is a liquid and safe asset in your balance sheet and what is an investment. All those things that I just mentioned are investments because they have inherent risk associated to it. Okay,
yeah,
so
Okay, let's go
Please.
back, just circle back, just real quick on that because I think there's some really good points you made, and I'm gonna say it in my terms, and then you can probably bring some clarity to that. There are certain things that do not go backwards in value. They provide what we call liquidity, and liquidity means I can get access to them with relative ease, with the certainty that it's going to be that value the day I go get it.
Mhm.
Roughly said, right? Is that fair
Yeah.
to say?
Yeah.
What I see and you see, and I know you've done a lot of these seminars, you've done a lot of teaching with people around the country, and a lot of people want to naturally take what they perceive as liquidity, which is not really liquidity, right? This is the misclassification we run into. Hey, I have a home equity line of credit. They see that as liquidity, but it may or may not be, right? More than likely,
Mhm.
it's not because you don't have a guarantee that it's a certain value. You don't have a guarantee that it's going to be there when you need it, right?
Mhm.
Fair to say. My 401k, oh, that's liquidity. I can get a loan against it. Maybe, maybe not. So there's when you can say maybe, maybe not, then that's not true liquidity because the
Mhm.
time you need it, the absolute stressed, the most stressed you are in your life, or you're finding the greatest opportunity. If they can tell you no, then it's not liquid. It's not a liquid asset. It's an investment. Would you agree with that conversation?
And this is why I think it's so important. From just looking at the balance sheet, if I look at your home equity, okay, let's just say the home equity, that would be part of your balance sheet on your investment portfolio. And the fact that you can put debt against it to access some of the equity is a debt strategy with an investment asset. It's not a liquid safe asset at the top. The same is true for a retirement account. The fact that you can take a loan against the values in your 401k doesn't mean that that's a liquid safe asset. It means that you can implement a debt strategy within an asset you own in your investment portfolio. The distinction would be this. What would happen if your home equity or your 401k values drop 50%? Would you have the same access to that same debt strategy? Would you be called on paying collateral or paying
Margin call.
immediately margin call, right? And a liquid and save, if you have a savings account, treasuries, a life insurance policy, that inherent risk is not the same because values don't go backwards, like you said. If you have $1,000 in a savings account and it's a depository account, at any time I can call on those $1,000, regardless of what's happening to interest rates, markets, recessions, et cetera, et cetera. That level of certainty and safety is what we call liquid and safe assets.
Yeah. Yeah, I agree with you 100% because again, I've had clients that say, "Well, I own all this farmland. I can always borrow against it." When you have to have somebody else give you authority to get cash, then it's not liquid. I think it's probably the best way I've ever explained it to people. And you know, and people say, "Well, that'll never happen." And we all know that's not the truth, right? There's always that opportunity. There's no contractual guarantee that somebody has to give you just because you own $1 million or $10 million worth of farmland that's debt free. They don't have to give you a loan.
Yeah. Yes, it's a debt strategy of an asset you
Of an
own that
asset.
is part of your investment portfolio. And if we bring tough money back to the conversation, it all works well when you're in times of peace. I call that, right? In times of no war. But try to access liquidity from a home equity line of credit in 2008. What bank was offering happily a line of credit against equities in a home in 2008? Access to credit from a retirement account where you accessing in 2001 in the dot-com crash. So there's some things here that when events come, the place where you will find liquidity is from places that have guarantees or safety liquidity, and that's why we separate these two things. Again,
Yeah.
no right or wrong. We're just giving you a framework, and you need to decide if you agree with this framework to manage risk versus acceleration, foundation versus acceleration. You could disagree with us, but I tell you, the time where you're tested through events will bring clarity to what is and what is not actual safety and liquidity. I think you have plenty stories of that in your podcast, so we don't need to go any deeper on that. But
Yeah.
to move the conversation forward, so now that we've identified what is and what is not a liquid and safe asset, in your preference on how you allocate that. You'll do the exercise to know how much money you have in all of those areas, and you add all that to identify what are your total liquid assets. And in this exercise that we present to communities, we typically use a family that is at the top 10% of income earners or $150,000 a year. And a family in this category typically will have, let's say, $50,000 in liquid assets. So big realization moment. My God, we only have, or we have 50,000, depending on how you feel about it. We only have might be we don't have enough, or Maybe 50,000 is all you think you need, but there's no right or wrong. You will just become very clear about that. And the layer question above that is, let's start to think about how these environments are working for me. Are they efficient enough, and are they giving me enough benefits for this to be the place that I want to continue to store liquid safe assets moving forward, Wade?
Right. Okay.
So one more thing, and then we'll move on. If you want to the next conversation, we will ask people, hey, what is the current yield that you're earning in your liquid safe assets? What is your minimum standard, and how would you like to target maybe a little more efficiency? That's a whole conversation that brings into perspective that we're not thinking about that. A lot of blank stares, a lot of silence when we ask those questions, which is intentional because what we want to help people think is cash and savings does not have to be a dead money conversation.
It's not a trade-off, is it? It doesn't have to be a
Correct.
trade-off.
Correct. And we need to get very clear about what the right expectations should be for liquid and safe assets in terms of yield. We start with yield because that's the closest thought to people when they think about benefits. And we zoom out and we say, hey, what other benefits you get? Do you get any inflation protection or yield or liquidity or safe? And the moment people see that there's a broader conversation, they're willing to now consider this as a more serious conversation. Where am I storing my liquid and safe assets? How do I reduce the trade-offs? How do I maximize the efficiency? Just very powerful conversation, Wade.
Yeah, because and this is always the issue, right? This is not a water cooler conversation, right? People aren't like super excited, thump their chest, coming up to the water cooler and say, "You should see my days of liquidity. You should see how much liquidity I have."
Yes.
Well, no, nobody has any context about it, and then the other side of the equation is like, it's not like, oh, you didn't get 40% return on your money, no. So
Yeah.
it's it's just sometimes it's hard to have that, but it is the foundational part of our conversation because again, that's the part that leads us to be able to do all the other things in us. And again, it's the sequence of having liquidity before we go out and find ways to maximize our wealth, because
Yes.
that's the security and that's the foundation. That's like you said, if you're building a skyscraper in New York, nobody talks about the foundation.
Yeah.
Nobody talks about the half mile, the quarter mile pilings down to bedrock, which is so vital, but nobody talks about it.
Yes.
So,
And I agree with you. This is definitely the grinding sand part of the conversation because it's painful. It's difficult. We asked this question as part of the workshop, where were you saving 10 years ago? And that reflection alone is very profound. Because if you go back to today, at the day of this recording, we're at the end of 2024, so it'll be 2014. When you see what was happening to interest rates, to places to store, well, there was no yield to be found. And the answer we get to this is bank, 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 which tells me no one was really thoughtful about how they were managing their liquidity strategy. Or
yep,
this is not a common conversation. And I'm talking about the fact that we have people earning $10 million a year having this conversation with college students earning $20,000 having this conversation in the same plain way. It's a very needed conversation, and we lead that savings environment discussion to the fact that, hey, perhaps there's, again, no right or wrong. How do, in the short term, do we find environments like a high yield savings account, for example, that can give me some yield, that can maximize some of the benefits in the short term for me to still have the speed of transactions I need to manage my business, my family expenses, etc. And also there's a conversation about longer term. Where am I going to store long-term wealth, long-term liquidity, perhaps life insurance, because of the benefits associated to it, because I reduce my benefit trade-off, because I maximize the long-term yield, and I hedge against volatility in interest rates and maybe increasing taxation, inflation. All this thoughtful conversation about understanding the options available to you and what assets you use for different purposes with different durations to manage your liquidity strategy.
yeah. No, I think that's an important distinction. Is like what we want to do is bring some awareness to people. People going, is it like anything else? It's like with even the debt conversation, anything else. There's not an A or B.
Hmm.
There's a spectrum along for everybody along lines. It's like here's one end of it, here's the other end of it. Where do we need to be with a certain amount of dollars? And we fall within there, right? So again, there's not just one place to put it. There's not just one way to do it. It's like what aligns your actions with your values, and how do we find
Yes.
those benefits that align your actions with your values? And and you will never hear me say it, you'll never hear you say it, that there's only one place to go with these dollars, or this is the only place I would put my dollars.
again, it's about awareness. And when you know what's going on, you can see what the values are for each of those things along that spectrum. You'll know where to go with the portions of your dollars.
Yes, yes, yeah. You'll make the decisions you need to make from a place of confidence. Yeah. This conversation again, very important because at a foundational level, not a lot of education at a workplace, at the schools, universities. So it's nuanced, it's new, and it makes people think more deeply about their security and their ability to take future opportunity with their liquidity. And then the last part of the exercise is a more thoughtful conversation about liquidity strategy. How much, now that you've identified where you want to keep this for different purposes, how much of it should you have? How much is too much money to have available to you, Wade?
Yeah.
It seems like a trivial question, but you hear a few years ago, cash is trash, right? How do you contrast that level of thinking with the need that you have today in your stage of life to have liquidity available to you? And we go through this fascinating exercise. It's so simple, but ah man, the feedback we get is fascinating. We're gonna help you calculate what we call your days of liquidity. You're gonna take your annual expenses and divide it by a daily expense rate, and you're gonna calculate that daily burn rate. $200, $300, 400 is what it takes you every day to live your lifestyle. And you're going to contrast that against your liquid assets, and it's going to give you your days of liquidity. How many days of freedom do you have? If you stop receiving income today, how many days could you live with the liquid safe assets you currently own? And this is very important because we live in a country where most businesses, in average, have less than 27 days of liquid assets. A month without revenue, 2020 was the great proof of this, will make you close permanently for business.
Yeah.
And we, again, use this common and uncommon framework. Do you want to be commonly holding days of liquidity is less than a month, or do you want to be completely free and have 5 years of liquidity? So events that come your way do not matter because you have tough money.
I think that that's a prime example of this idea of anti-fragility, right? Are we
Yes.
prepared for that? Have we tested ourselves long? So when we have these events, not opportunities, where those events come, or for whatever reason we don't have a commission check coming in, and or this year's crop was terrible, or whatever is happening in our lives, do we have that liquidity that can take us
Yes.
through that time and finding that? And it's interesting. Again, you're doing seminars with people all over the country about this, and one of the big takeaways, I was in a seminar, was helping with one of these, and there was a gentleman there that made the comment. His biggest takeaway, and this is, these are people that make $1 million a year,
Yeah.
that are having this awareness, this big aha. I mean, their eyes just like lit up. He came back and he was saying, this one gentleman was saying, I didn't realize what my burn rate was. I didn't realize how few days of liquidity I had. And again,
Yeah.
he makes a tremendous income, but there is no correlation between income and liquidity if you're not intentional about it.
I'll tell you two examples that we are using in the conversation. One came from the room, and the other one is just things that we're learning from Smart Money. I call Smart Money these people that are incredible, successful investor like Warren Buffett, for example. But
Right.
somebody said in one of the events we attended something that has stuck with me because not exactly what he said. The way he said it was exactly the way I wanted to feel about my money. And he said this. We were having a conversation about 2008 and 2011, and they were admitting in the room, 2008 was really tough. Some people had to give their properties back to a bank. Some people were able to float themselves. Regardless, everyone had scars from this experience. These are seasoned investors going through multiple cycles. And one of the gentlemen said, the way I heal myself from 2008, the scars in my back, is that I today, at any point, hold 5 years of liquid assets in my portfolio. Because if the market goes down 20, 30, 40, 60%, what I would do is nothing. I have that liquidity and it sets me free to encounter any event moving forward. And after the event, I will have the opportunity to go in a buying spree. And when he said that, man, the impact in the room was silence, right? Because it's really interesting to see someone with the confidence to understand whether you think it's right or wrong that he has an opportunity cost to having all that cash accumulated. This guy is living in a way that when he goes to bed, he puts his head on the pillow and he goes to sleep at peace.
Yeah.
Most Americans are not living like that right now, Wade. Most Americans are not living like that right now. And The contrasting story that we tell in the seminars is Mr. Buffett, right? The guy that got the call from Fold, from Lehman Brothers saying, can you bail us out? Can you give us a loan, right? Not a lot of people got a call from Lehman Brothers in
No.
2008 or 9, right? Not because Warren's special, because Warren had cash. It's the golden rule. Okay. And if you study what's happening with Berkshire Hathaway this year, they've gone on a significant, actually a sustained long period of accumulating more and more cash as a percentage of their balance sheet. What they've done this year is unprecedented. They sold a ton of Bank of America, a ton of Apple. And their liquidity as of this last quarter and third quarter was $325 billion. That's with a B. And for most people, that number will mean nothing. But I can tell you that as a percentage of their total assets in their balance sheet, that's almost a 30% allocation to cash. This is
So
the
just to put
guy
it,
that,
yeah,
oh, sorry.
to put it in terms, right? So imagine if you had a net worth of $1 million, just real simple terms. That would be like having $350,000
Cash.
in a cash reserve. Again, not an
Yeah.
investment we can leverage against, but a cash type of holdings.
And if you think about it at an individual level, even if that's significant, no big deal. But this is a guy that has the pressure of a board of directors and of stockholders saying you are in the business of allocating capital to create yield for the business. And yet he is doing this at a very aggressive pace. And we share this because I don't think Warren is timing the market. I think Warren lives in a paradigm of tough money. He is very clear about when his cash has a great opportunity cost to buying things like stocks, for example.
Yeah.
And if smart money is moving towards a position of having more liquidity and value in liquidity here, I think at a minimum, we all should pay attention to what is happening, what is causing him to think like that, and how does this relate to my position with my daily burn rate and my days of liquidity weight. So bigger conversation here for this part of the workbook. What we're talking about is let's just get clear about what's liquidity and what's not in our balance sheet, and where are we deciding to store that liquidity, and how much of it should we have to be, again, protected if needed, or to be able to take advantage of opportunity if opportunity shows up.
And what the expectation is of that money, right? As far as
Mhm.
yield, other benefits it might provide. I mean, I think that's the important part is what's our expectation of our liquidity? And it's not just like, hey, we got one option and we put it there because it's the only thing we can do. Let's find a reasonable spectrum of where we can store dollars that gives us those benefits that we want. I think that's the real important part of the conversation.
Agreed. Agreed.
So, well, again, David, this is huge. I love this conversation because this is it is so needed by people because it's a process that we're going through. So, thank you so much for this conversation about liquidity. Part 4 and our final part in the Tough Money conversation is going to be on
Investing.
investing.
What's the relationship of your liquidity with the things you own in your balance sheet that represents your investments? Yes, sir.
Perfect. I'm looking forward to that. So again, thank you so much, David, for your time. I look forward to part 4 of this conversation.
Thank you for having me.
You bet.
If you're enjoying this podcast or know anyone else that might be interested, please be sure to hit the subscribe button and please leave a review. This will help this podcast reach and help more people by ranking higher in searches and ultimately help more people get out of financial bondage. And don't be afraid to share this podcast with your friends and family, as we can be easily found on Apple Podcasts and Spotify.